welcome to BISP Solutions. So today we are going to cover Accounting Standard Codification 705, 740 and 810. So 705, Accounting Standard Codification 705, it stands for Cost of Sales and Services. 705, again it's bifurcated into two subparts, that is 705 underscore 10 and 705.20. 705.10 is overall, and 705.20 it says for accounting for cash consideration received from the vendor. Here it just talks about the presentation point of view, that is cost of sales line item and how you reevaluate that. Okay. So this standard provides guidance on accounting for expenses which are directly related to producing goods or providing services. It includes rules on how to recognize the consideration received from vendors, treating it as a reduction in the cost of acquired goods or services if certain criteria are met. Accounting Standard Codification 705 essentially ensures that the costs, they are properly matched with the revenues they help generate in the correct accounting period. Now there are some key aspects as I defined 705.10, which talks about overall, which links to other guidance on cost of sales and services with the FASB codification, and 705.20 it's accounting for consideration received from a vendor, which addresses how to account for incentives which is received from vendors like cash or credits. Now vendor consideration, if you talk about, so 705.20 under 705 sub 20 subtopic, entities must determine if consideration received from a vendor is a reduction of the purchase price or if it should be accounted for under the revenue guidance, which is based on the criteria from revenue recognition standard that we have already seen, that is Accounting Standard Codification 606. This standard purpose is to ensure accurate and timely recognition of expenses to properly match them with the related revenues, and a fundamental principle of accrual accounting should be followed. Now if you talk about the compliance, so generative AI and other software, it can help with Accounting Standard Codification 705 compliance by automating your cost analysis, improving the data accuracy and ensuring comprehensive result, or you can do a comprehensive documentation. So this was all about 705. Now we'll start with Accounting Standard Codification 740. So 740 requires that the effect of changes in tax laws or rates can be recognized in the financial statement as of the date of enhancement or the enactment. So 740, that is your income taxes. It's again bifurcated into four. First it is 740.10, then it is 740.20, then 740.30 and 740.40. So 740.10 again talks about the overall standard. 740.20 it's an intra-period tax allocation. 740.30 it's a limited exception, or you can say other consideration of specific areas. And here it talks about the comprehensive income also, that is FX translation adjustment, changes in the pension fund status. Here this standard also talks about the interim reporting, that is computation of income tax for interim periods. How will you compute it? Secondly, the requirements applicable to discontinued operations and unusual or infrequently occurring items which are related to the income taxes for interim periods. Here we also see the application of the income taxes computation to some specific situations. The new tax legislation and income tax provisions and the guidelines which are related to the new legislation. Special computation of income taxes for operations that are taxable in various multiple jurisdictions, and the interim period income tax disclosure requirements. So this all talks about the interim reporting. The standards also talks about like suppose if there is an income tax accounting, it's done on the basis of income tax accounting, either done on the basis of intra period minus you allocate the tax. Okay, this is talked about. This is discussed in Accounting Standard Codification 70420, or if you say inter period minus tax allocation. So intra period, or you can say inter period, which is talked in 30 Accounting Standard Code 740/30. So income tax return versus financial statement. Here it compares what IRS has said to tax and what FASB has said to GAAP. Now it also talks about the permanent differences, temporary differences. Now permanent differences are those differences which cannot be reversed in the future, which you can create it now but cannot reverse it in the future. These do not affect the deferred tax computation. It only affects the current tax computation. Permanent differences, it's a transaction that affects either the taxable income or the income per books. These are either non-deductible, non-taxable or special tax allowances. Some example if you consider of the permanent differences like tax exempt interest, certain penalties, bribes, fines, or you can say entertainment expenses which are non-deductible. So suppose if I have paid fine of 5,000 to the traffic policeman for not following the rules. So if I am debiting in my P&L, I am showing debiting that particular expense, fines of 5,000 and claiming it as an expense, which is not disallowed by Companies Act, but as per Income Tax Act, this particular expense is disallowed. So that's why you see this revenue, you can, as per Companies Act, you can debit it, but when you file or prepare the P&L as per Income Tax Act, this fines cannot be is not a deductible expense. So you see the difference will be created as per the Companies Act and Income Tax Act. That is a 5,000 difference. So that's a permanent nature difference. Now, what are the temporary differences? These do affect the deferred tax computation. So these are the items that first recognized for financial statement purpose, they will be eventually be recognized for tax purposes, and vice versa is the case. These differences affect the future period and results either in deferred tax asset or deferred tax liability. There are 4 primary causes of temporary differences. So temporary differences, as I talked about, so it is either a deferred tax asset or liability. It can be reversed in future. Like you talk about the depreciation. Suppose as per Companies Act, your depreciation percentage that will be charged, here you will talk about SLM. So that means 20,000, 1 lakh asset value is there. In 5 years it needs to be or in 4 years it needs to be depreciated. Suppose asset value is 1 lakh. Life, you can consider it as 5. So depreciation will be 1 lakh divided by 5, that is 20,000. Okay, so 5 into 2, that is 5 years, you will every time charge 20,000 depreciation. So in every year you will have a depreciation of 20,000 charged in your P&L. But in your, as per your income tax, suppose 10% depreciation is there. So on 1 lakh asset, 10%, that means 10,000. So asset value is 1 lakh, 10% on that will be 10,000. So you will debit 10,000 depreciation. In Companies Act, debiting 20,000, but income tax is debiting 10,000. So you can see there's a difference. Obviously, here less profit will be there and here more profit will be there. Because suppose if your net profit, net income is in this case 2 lakh, 20,000 depreciation deductible. So you will get 1,80,000 on this tax amount will be charged. But in this case, if 2 lakh is the net income, you will get a depreciation of 10,000 deductible and 190 will be your net profit, and on this tax percentage will be charged. So if you see 30% is the tax, so 54,000 as per Companies Act and 57,000. So 3,000 difference is coming. That's a temporary nature difference. Temporary nature difference. Okay, this 3,000. So in this way, you and these in the later of years, you will able to set off this difference. So there are some primary causes of the temporary differences. So if you talk about the primary causes for temporary differences, if it talks about that this is your taxable income, then this is your financial income, then we'll see DTA or DTL, that is deferred tax asset or deferred tax liability. Revenue or gains. So if there's a revenue or gains, a taxable income is there, it will be later recognized. In case of financial income, it will be now recognized, and in this case DTL will be created. Now suppose advance payment is there, okay, so in this case also you will taxable income will give you deduction now, financial income will give you the deduction later, so deferred tax asset will be created. So you have to decide when deferred tax asset will be created, when deferred tax liability will be created. If you have to, as per income tax, like you see, if you have to pay more tax now, so in future you will get the benefit. When you will get the benefit, that means this 3000 is your deferred tax asset, and vice versa is the case. Suppose income tax act say you have to pay 53,000, but Companies Act say no, you have to pay 54,000. So Companies Act is paying more, right? That means giving more. It's allowing you to pay more tax now, and in future you will get the benefit. So accordingly you will create a deferred tax liability because you are paying less as per income tax, because ultimately what income tax say that you have to pay. So you are paying which is right now 53,000 is the tax, that means you are paying less. In future you have to pay more, so reversal will be there. Okay, so that's the reason. Now if you say Companies Act, as per Companies Act your tax amount is 5,000, but as per your Income Tax Act your tax amount is 6,000. That means you have to pay ultimately what income tax says. So if you are paying this 6,000 tax, that means you are paying more tax. So in future you will get, right now you are paying more, in future you will get the deduction, so you will create a DTA of 1,000. But as per Companies Act, suppose it says 2,000 you need to pay, but Income Tax Act says you need to pay 1,500. That means right now it is giving you benefit, in future it will ask you to pay more. So DTL will be created of 500. Okay, so this will be the scenario. Okay, now moving on to the next standard and the last standard codification, that is Accounting Standard Codification 810, which talks about the consolidation. Now under that you have 81010, 81020, and then 81030. So you must be knowing these all are the consolidation methods. So you must be knowing from, if there's a line, so 0 to 30 to 50 to 80 and to 100. So when subsidiary and holding relationship will come, when holding company has invested or acquired more than 50% shares. If they have acquired more than 50% shares, then the other company becomes our subsidiary company. That means we have full control it, and consolidated financial statement will be prepared. But if the holding company has invested 50%, so the other company becomes our joint venture. In that case, in case consolidated financial statement is not prepared, 50% of the assets is required and proportional method needs to be applied. Now if it is less than 50%, less than 50 but more than 20, so in that case it will be equity method will be applied, and it should have a substantial interest. Okay, so in this case you see the ownership structure and then define what method of consolidation will be applied. Okay, so in this case if you see it is 0 to 30, so if it is more than 20, so here equity method. On 50 it will be joint venture. Here you will have subsidiary, and here also you will have subsidiary, and below this no consolidation, even nothing will happen. You won't show it also. Okay. Now what is voting interest? So control now means what? Control means when more than 50% of the investee stock has been acquired, or when control over an investee is established, a parent subsidiary relationship is said to be formed. So that is your control. That means over 50% ownership. So exceptions do not consolidate. So subsidiary is a bankrupt, suppose a subsidiary is involved in a legal proceeding, or subsidiary operates under severe foreign restrictions. In that case, we do not consolidate even if it is 100% or more than 80% also. And controlling interest means, so an investor is said to have a controlling interest in the subsidiary when it owns more than 50%. Okay, non-controlling interest means it is that portion of the net asset of a subsidiary that is not attributable to parent. On the consolidated balance sheet, the NCI is reported at fair value in the equity net asset section separately from the parent's equity. Now variable interest entity model is, these are the entities that either lack sufficient economic resources to support its operations, or does not have equity investors with voting rights, for example partnerships, LLCs, trust, corporations, or any other legal setups. Now primary beneficiaries, like it is an entity that has significant impact on financial performance. It absorbs variable interest entity model expected losses and gets the expected residual returns of the VIEs. The primary beneficiary has the power to direct the activities of the VIE, that is variable interest entity model. Now acquisition method means the accounting for an acquisition begins at the acquisition date. The investment is valued at the fair value of the consideration given or received, whichever is evident. So the two important accounting features of this method are, first, the subsidiary's entire equity is eliminated, that is not reported when consolidating. Second, 100% of the net assets acquired, they are all reported at the fair value regardless of what is acquired. Now suppose XYZ Corporation announces that it is going to buy a Ruby subsidiary company on August 15th, year 5. It has agreed to buy $1 lakh shares of its common stock. Now, according to the market price, that is December 15, transaction gets closed. Now, stock price gets changes to 22, and when it was announced, it was 18. Okay, so the acquisition price would be, so when transaction gets closed, the stock price is 22 and 1 lakh shares are there. Now how will you record it? We will say investment in subsidiary. Investment will be 1 lakh into 22, and to cash account credit, that is 22 lakhs. Okay, 20 is their par value, so cash account credit will be 22 lakhs, and if you bifurcate it, so common stock will be, out of this you can say common stock, if you bifurcate it, so common stock will be 20 lakhs and 2 lakhs will be your additional paid in capital that we have yesterday seen. Additional paid in capital. Okay. Now last we'll see how we'll pass the eliminating journal entry. So we'll say common stock account debit, common stock account debit, additional paid in capital debit, retained earnings debit, balance sheet adjustments at fair value debit, Identifiable intangible assets, intangible assets which are identifiable, that is debit, and goodwill account debit. And you will credit non-controlling interest, or that is your minority interest, account credit, and investment in subsidiary account credit. So when you have done the investment, what all things you have acquired, that all you will debit it. Investment in subsidiary credit. So this is how you will pass the journal entry. Yeah, so that's all for today. This is that's all we have covered in this standard talks about, that is consolidation 810. Then this is your income taxes, and this is your cost of sales and services. Yeah, so that's all for today. If you have any doubt, please contact BISP Solutions. Thank you all for your time.